Global economic news for today. Geopolitical conflict catalyzes global energy price volatility. Escalating regional hostilities in the Middle East have reintroduced a stagflationary impulse into the international landscape by driving up fuel costs. This energy shock is broadening beyond oil, heavily impacting maritime shipping insurance premiums, transportation logistics, and commercial confidence worldwide. Central banks pivot toward extended restrictive monetary policies. The previous expectation of gradual interest rate cuts has been sharply scaled back by major financial authorities as sticky inflation returns. Policymakers are signaling that borrow costs must remain high for an extended duration to suppress persistent domestic price pressures. Sovereign debt burdens amplify fiscal risks in developing nations. Rising government borrowing across emerging markets is creating an expensive cycle of elevated interest rates and steep debt service obligations. This financial strain is disproportionately affecting countries with historical defaults or weaker regulatory governance, threatening broader economic stability. Global growth disparities widen across major developed economies. A clear divergence is appearing between major financial regions, as domestic spending power and labor market resilience vary. While certain Western jurisdictions maintain a steady economic pace, others are experiencing cooling consumer demand and sluggish industrial output. International shipping route disruptions elevate supply chain expenses. Persistent security threats along critical maritime transport corridors have forced commercial cargo fleets to utilize longer, costlier alternative paths. This ongoing logistical friction is driving up input costs for manufacturers and creating localized inventory shortages. Household discretionary spending weakens under real wage erosion. Despite a generally stable employment landscape, the sudden resurgence in energy and food prices is outpacing household earnings growth. This compression of purchasing power is slowing down consumer spending on non-essential services and retail goods. Equity markets demonstrate defiant resilience amid mounting risk. International stock indices have climbed toward historic heights, showing an unexpected tolerance for worsening macroeconomic and political challenges. Investors appear hesitant to abandon growth assets while corporate earnings expectations hold steady, though market volatility remains intense. Industrial policy and state subsidies shape clean energy supply chains. Major sovereign powers are increasingly utilizing heavy financial incentives and trade protections to domesticate advanced technology and green infrastructure manufacturing. While this fuels domestic construction, it risks creating market inefficiencies and worsening international trade frictions. Public defense expenditure surges to counter regional instability. National governments are rapidly adjusting fiscal priorities, allocating a larger share of state budgets toward domestic military modernization and defense readiness. This structural pivot provides a localized lift to manufacturing but intensifies pressure on existing public deficits. Bond markets experience heightened volatility over shifting policy risks. Long-term government bond yields are drifting upward as institutional investors demand a higher premium for inflation and fiscal uncertainty. This movement reflects a deep uneasiness in fixed income markets regarding the future trajectory of central bank decisions. Commodity exporting nations struggle with large revenue swings. Recent turbulence in global resource markets has highlighted the structural vulnerability of developing economies dependent on raw material exports. Windfall revenues from brief price spikes are rapidly consumed by state spending, leaving limited fiscal buffers when markets turn downward. Corporate investment shifts focus toward advanced digital automation, faced with tight labor pools, rising input costs, and shifting operational landscapes. Corporations are prioritizing capital expenditure toward artificial intelligence and automation. This strategic technology adoption aims to preserve profit margins by structural productivity enhancements rather than expanding payrolls. Thank you for your attention.